Everybody across the United States is filling out their NCAA brackets to figure out who's going to win the NCAA tournament. And we're going to do a different kind of bracket. We've got the March Madness bracket of tax savings. And we've got the Final Four of folks who have made it to the Final Four relative to the top tax deferral strategies that are out there. And we've got on the West Coast, we've got the 1031 exchange and the conservation easements pairing off. I'm not exactly sure how conservation easements even made it to the Final Four, but nevertheless, that Cinderella story is there, so we can see if they're going to pull it off. And in the East, we've got opportunity zones going head-to-head against 401ks and IRAs, and we're going to see who's going to meet up in the championship game. I'm going to walk you through exactly why I think that which one are better than each other in both the West and the East. And 1031 exchange versus conservation easements, I don't think that it's even a question. Once again, I'm not even sure how conservation easements made it into the Final Four because they're a listed transaction, but they are a way that you can defer. And if you want to, effectively what a conservation easement is when you've got a piece of property and you put a conservation easement on it, you can get the deduction associated with, making that conservation easement contribution. Now, the thing about it is that you need to make sure that it is not a syndicated deal, because a syndicated deal is a listed transaction. And so what they've done is they've converted that into a charitable donation now, where it's a fee simple donation as opposed to just a syndication of the conservation easement, which makes it a little bit better. But still, it's I don't necessarily know that it's as great in the eyes of the IRS. And effectively what you can do is you can ultimately reduce up to 30% of your adjusted gross income by investing into one of these conservation easement deals. Now, in 1031 exchange, you're basically deferring tax deferred dollars. And, so it's a dollar for dollar tax deferral when you put your money from the sale of real estate with a qualified intermediary to make sure that you get that tax deferral. So in this West bracket, I don't think that there's any question between the two of these, which go head to head, that I'm a big fan, and I think that the 1031 exchange is going to prevail over here. That 1031 exchange is really powerful because you can completely defer all the taxes that are due, and instead of it being just an offset, it's a complete deferral. Now let's go to the East. Opportunity zones versus 401k IRA. Now, I love a 401k. And I love an IRA because it is a tax-deferred way for you to get money into those, and then you're going to ultimately grow that money tax-free inside of your plan. And then when you go to exit those, and this is the problem with 401ks and IRAs, is that when you go to take the money out after it's grown tax-free, you're going to pay taxes. You also have these things called required minimum distributions. And man, those RMDs, you got to pay very close attention to them. Now, I will say that this 401k, that you can do a Roth conversion inside of that. And with a Roth conversion, that can actually get really powerful, because a Roth conversion converts it into a Roth IRA, which grows tax-free, and then ultimately you can exit it tax-free, which gets it close to opportunity zones, because opportunity zones, you get to defer taxes going in, and then it grows tax-free, and when you exit it, it comes out tax-free with a step up in basis to fair market value. Here's the thing, and this is where I think that opportunity zones beat 401ks and IRAs, is because of, and namely, if this was a Roth one, I don't know, I'd have to put them side by side on it. And I think that Roths might be a little bit, and they may even have an edge, just depending on your circumstances. But in this case, opportunity zones head-to-head versus 401ks. Opportunity zones are the clear winner. So op zones are now going head-to-head with 1031's exchange for the national championship. And let's talk about the two of those. Let's talk about 1031 exchanges versus opportunity zones. And they're very similar, namely in the fact that you're deferring under a provision of the Internal Revenue Code. So for opportunity zones, it's 1400Z, and under 1031s, surprise, surprise, it's Section 1031. And so accordingly, you get to defer the taxes, and in both scenarios. Now with op zones, you're ultimately going to pay those taxes on December 31st, 2026. And man, so we're, in the first half, where op zones are coming out of the gate and they just took an L. So 1031 exchanges going into halftime are ahead, because namely inside of that, you're paying the taxes on op zones, and you got to pay those in 12/31/2026. Whereas with 1031 exchanges, you don't pay those until you die, or when you exit the property and you don't continue to 1031 it. So it allows you to kick the can down the curb. And then when you die, you get a step up in basis to fair market value. So we're coming back out after halftime, and we're evaluating op zones versus 1031s. And man, that step up in basis to fair market value is now on the court. We just got him off the bench, and holy cow, let's talk about that. After 10 years, you get that step up in basis to fair market value, which means that whatever you're going to exit this at, that's what your new basis is going to be. And what that effectively does is it eliminates capital gains, and it also eliminates depreciation recapture. So that becomes really powerful, because it allows you to take, over the course of your investment, you get to use depreciation in order to offset the income on that investment. And then after a 10-year hold, once again, it's that magic number of 10 years, you get to exit it completely tax-free. So holy cow, opportunity zones just caught up on that lead. The other thing that I love about opportunity zones that doesn't happen in 1031s is that 1031s are only available for real estate. And so, wow, once again, opportunity zones pull ahead. Whoa, wait a second. I think 1031s are catching up, because 1031s are place-based. They're real estate specific, but they're not specifically place-based, whereas opportunity zones are. You can only invest into specific census tracts that are designated by the governors. Wow, we're neck and neck. So what's going to be the thing that's going to decide whether we go with op zones or 1031 exchanges as our national champion? And I think that this is the answer, is that when you have a 1031 exchange, you are effectively kicking the can down the curb on your taxes until you die. And when you die, you do get a step up in basis to the then current fair market value. The problem is that when you die, you get a step up in basis. And so accordingly, you have to pay the taxes on the amount within 180 days. Now, when the lifetime exemption amount is over $20 million like it is today, that's usually not a big deal for most estates. But that's getting ready to drop in 2025 to between $10 and $13 million. And now, all of a sudden, anything above that is now going to be taxed within 180 days at 40%. Whereas in opportunity zones, the amount that goes against your lifetime exemption is only the amount that you contributed into your qualified opportunity fund, which is your original gain amount. So whatever it's grown to over the next however many years, at least 10, but all the way up till 2047, it comes out completely tax-free. So at the buzzer, we've got opportunity zones sinking a 3 for the W, and opportunity zones walk away as the national champion. If you're interested in learning more about all 4 of these tax strategies, this is what we do at OZPros. We'd love to help you out, and we'd love to help you evaluate how you can mitigate taxes on not just your capital gains, but on your ordinary income, and to rebalance your portfolio in order to make it as tax advantaged as possible. Because in the world of wealth, it's not what you make, it's what you keep, and we're here to let you keep as much as you can. Check us out at OZPros.com. Click the link below. Go to OZPros and fill it out, and we'd love to set a call to review your tax strategies today. Get on the map, get your brackets done, and let us know how we can help. OZ Sherpa, Ashley Tison, out.